Is a Vanguard S&P 500 index fund all you need in your investment portfolio? Warren Buffett famously recommended that the cash left to his wife be invested in 10% short-term government bonds and 90% in a Vanguard S&P 500 index fund. And Charlie Munger, his business partner, says
S&P algorithm is very hard to beat in a diversified portfolio of big companies.
How do you know if this is an investment strategy that you should really copy? Let's get into it. Hi, I'm Stephen White, a chartered investment analyst with 15 years investment industry experience. And on this channel, we discuss tips and strategies to help you become a more confident, effective investor and build your wealth over time. In today's video, I'm going to break down 10 key considerations you should make before pulling the trigger on investing in an S&P 500 index fund from Vanguard. And stick around till the end for my bonus consideration, which could help you build your investing confidence and experience more generally. And by the end of this video, you should have a better idea on whether this is the right investment approach for you. First off, before you make any investment decision, you need to think about your goals. What are you trying to achieve? Are you investing to build a big pension or retirement pot in the hope of retiring early? Are you saving for major life events like buying a house or paying for a wedding or starting a business? Are you looking to build a nest egg for your children to pay for future college or university tuition? Maybe you're looking to invest aggressively to become a millionaire as quickly as possible. Or are you close to retirement or even in retirement and looking to draw income in your later years? All of these are perfectly sensible questions to ask when thinking about what you want your investments to do for you. Is investing in the S&P 500 even the right approach for you and your goals? Not necessarily. And that brings us on to the second related consideration, which is time horizon. If you're in your 20s, 30s, or 40s, and you're investing for the long term to build wealth for retirement, then you have a long time horizon. Investing in stocks and shares markets like the S&P 500 is considered a higher risk strategy. And the S&P 500 index does have a long-term track record of delivering attractive returns for investors, so this could be a good investment for your pension savings or long-term financial goals like investing for your children's future. If you're saving for major life events like buying a house or paying for a wedding or starting a business, and you need the money in the next 3 years, then investing in the S&P 500 could be the wrong investment approach for you. There's a chance you could lose money at exactly the wrong time. For example, in 2022, the S&P 500 lost over 18% of its value. If you'd have invested £100,000 and then needed that money to buy a house at the end of the year, you would have lost nearly £20,000. And that could be the difference between securing your dream home or losing out to another bidder.
Emotional damage.
And if you're coming up to retirement or even in retirement, you're probably thinking about drawing income from your investments. In this scenario, your time horizon is much shorter and your risk tolerance is going to be much lower. Hey, quick one, if you want to make a really smart investment decision, go ahead and click execute on the like and subscribe button. That way you won't miss out on future investing tips and insights. Plus, it really helps the channel. Thank you. If you're still interested in the S&P 500, the next thing to consider is whether you pick an index mutual fund or an exchange-traded fund, or an ETF. Both track the index, but depending on your personal circumstances and the country you're investing from, these products will have different tax implications, which will impact your returns, your portfolio value, and your tax liabilities over time. In the US, ETFs are considered more tax efficient due to their in-kind creation and redemption mechanism, which helps minimize realization of taxes. But that said, some US mutual funds are designed with tax efficiency in mind. In Europe, tax implications can also vary. In some countries, you can be liable for tax if a fund or ETF is distributing, meaning that the fund pays out dividends on a monthly, quarterly, or annual basis. And in some other European countries, you can be liable for taxes even if a fund is accumulating, meaning that the dividends are reinvested back into the fund or ETF. Many countries offer tax-free investment wrappers or accounts like the ISA in the UK or the Roth IRA in the US. These accounts enable you to invest in a way that your capital gains and your dividends or distributions are not liable to be taxed. Whichever way you look at it, it's critically important that you understand the tax implications of investing across platforms, accounts, and product types. It's smart then to get professional advice from qualified financial advisors who can advise you on the tax obligations in different investment scenarios. And even though this is not interesting, you should always check the fund documents which will advise you on the tax obligations for the country you're investing from. The next consideration to make before investing in an S&P 500 index fund or ETF is to check whether the strategy aligns with your values and your principles. Many investors don't want exposure to companies associated with tobacco or gambling or alcohol, so-called sin stocks, or they want to avoid companies associated with coal or oil sand exploitation. This is sometimes referred to as an avoid strategy. Other investors take a more conscious and deliberate approach to sustainable choices. For example, you might seek out a sustainable version of an S&P 500 ETF or index fund. In this case, picking a product like the Vanguard ESG US Stock ETF or the iShares S&P 500 ESG UCITS ETF could be viable alternatives for your portfolio. You may want to build a portfolio that targets reduced carbon emissions or invest in technologies associated with climate change and the climate transition. The key here is to make conscious choices around investment products that not only seek a financial return, but also aim to have a positive societal or climate impact. Okay, so you've thought about your goals, your investment strategy, whether you want an index fund or an ETF, and you've thought about your ESG considerations. The next thing to consider is other investment products that do the same thing from other investment companies. There are many other similar products from iShares, which is part of BlackRock, Xtrackers, Invesco, HSBC, Amundi, Lixor, UBS, and some of these have outperformed the S&P 500 over the last 3 years, according to industry website justetf.com. Additionally, the way these funds are structured can differ. For example, some S&P 500 ETFs are built with what's called full replication, meaning they buy the underlying securities in order to replicate the returns of the index. Others employ different methods like optimized sampling or unfunded swaps to recreate the same return profile. Optimized sampling essentially involves buying a basket of stocks which creates the same returns as the index, while unfunded swaps involves buying an equity derivatives contract that pays out returns mirroring the S&P 500. You need to decide which investment approach you're most comfortable with. And this underscores the importance of doing your research before making any investment decision. You want to know what's under the hood. Linked to the point about assessing competitive products, you also want to consider the costs of different options. According to Just ETF, the total expense ratio for S&P 500 ETFs in the UK can range from 0.05% to 0.15%. And although this can seem like a small difference, costs can eat into your portfolio return. For example, the Invesco S&P 500 UCITS ETF has a total expense ratio of 0.05%, which is 2 basis points or 0.02% cheaper than the Vanguard S&P 500 ETF. As a result, this ETF has actually delivered a 1% higher return over 3 years. Admittedly, it's not a lot, but it's not nothing either. And compounded over 20 years, that 2 basis points could fund a couple of nice holidays for you and your family in later years. Once you've settled on the product that you're interested in, you also need to factor in brokerage or platform costs. These can vary significantly. Some platforms and brokerages charge a platform fee for total assets. Others might charge dealing or transaction fees for actually buying an ETF or mutual fund. And some platforms might charge both. So it's crucial that you calculate the total cost of investing, including both platform fees and underlying fund charges. This will give you a better picture of how fees could impact your portfolio returns over time. Another downside of focusing solely on the S&P 500 is that you're missing out on investment opportunities elsewhere. Whilst the largest US companies undoubtedly offer value for long-term investors, there are many other markets that you could be investing in for growth or income. Markets like India and Taiwan offer attractive demographic and socioeconomic profiles, and international sectors and themes like technology, health, or infrastructure could also be attractive. In addition, smaller company markets like the Russell 3000 or FTSE 250 offer many exciting opportunities to invest in smaller companies with big growth potential. If you're investing for the long term, it can make a lot of sense to seek exposures to some of these smaller, less well-known sectors, themes, and markets. The next thing to think about is portfolio diversification. Warren Buffett has said that diversification is protection against ignorance. It makes very little sense for those who know what they are doing. What does this mean? Well, diversification means spreading your investments across different investment opportunities and not putting all your eggs in one basket. An S&P 500 index fund or ETF is a diversified portfolio. It offers exposure to 500 of the largest US companies and gives you a weighted average return across all those companies. Let's contrast it with another Vanguard product, the Vanguard Life Strategy 100 Equities Fund. This offers exposure to over 5,000 companies internationally. It's more diversified, and as a result, it offers lower volatility, but with lower returns on average. In fact, the Vanguard S&P 500 ETF has outperformed Vanguard's Life Strategy 100 Equities Fund on a 1, 3, 5, and 10-year time horizon. That track record is hard to argue with. The question for you is, are you comfortable with higher portfolio volatility, if it means you will likely generate better returns over the long term? Or do you want a smoother investment journey with fewer pronounced highs and lows? And here's the bonus consideration. While investing in a Vanguard S&P 500 index fund or ETF from Vanguard can be effective, you might want to consider investing in individual stocks and securities. This can actually be a good way to increase your knowledge and learning about investing generally. For example, Amazon stock is up nearly 60% year to date, and many analysts are projecting further gains from here. Whilst past performance is never a guarantee for future returns, investing in individual companies and stocks is fun, and it's more involved and can be a great way to increase your knowledge and experience over time. So bringing it all together before running out and buying a Vanguard S&P 500 index fund or ETF, you want to do your homework. Warren Buffett's strategy for his wife's future investments is a great strategy for her and her personal circumstances, but yours very likely differ. That said, I do see a lot of merit to this strategy for a lot of people. The S&P 500 index has delivered great returns for investors over the long term. And in my view, I do see this as a great core holding for many investors looking to accumulate wealth over the long term. Okay, I hope you found this video valuable. Don't forget to like and subscribe. And if you want to learn more about investing effectively, why don't you check out this recent popular video from my channel, which could give you even more tools to build a better portfolio. Until next time, keep investing selectively and effectively.